Breaking: the rise and fall of fintech innovation. What happened? Fintech innovation once symbolized the cutting edge of Africa's economic transformation, especially in vibrant hubs like Nigeria, Kenya, and South Africa. From digital payments to online lending and open banking, fintech startups promised to solve deeply entrenched problems: financial exclusion, limited credit access, and cross-border payment barriers. Investors flooded the sector with billions of dollars, and the media celebrated African fintech as the continent's leapfrog into the digital economy. However, by mid-2025, that optimism has dimmed. The sudden collapse of Nigeria's once prominent open banking startup, Okra, sent shockwaves across the African tech world, serving as a sobering lesson in overhyped growth and overlooked risks. Please like and subscribe to keep this channel alive. Founded in Lagos, Okra was hailed as a pioneer of open banking in Africa, allowing developers and businesses to securely access customers' financial data for loans, payments, and financial services. It raised millions in funding and built partnerships with major banks and fintech players. However, beneath the surface, its business model was fragile. Regulatory constraints, over-reliance on a few large clients, and the complexities of African banking infrastructure proved to be severe challenges. Okra's shutdown highlights a critical issue: many fintech startups scaled too quickly, assuming African markets would behave like their US or European counterparts. In reality, low digital literacy, fragmented payment rails, and inconsistent regulation slowed user adoption. Another major cause of fintech's stalling momentum is regulatory tightening. Across Africa, governments have become wary of fintech's unchecked growth. Nigeria's central bank, for example, imposed strict licensing rules, curbed crypto transactions, and tightened anti-money laundering oversight. In Kenya, regulators are cracking down on digital lenders accused of predatory practices. Many fintech firms, especially in lending, are now burdened by compliance costs and capped interest rates, eroding their profitability. For a sector once celebrated for disrupting banking, this regulatory wave feels like a rude awakening. Furthermore, investor appetite has cooled dramatically. Between 2019 and 2022, Africa's fintech sector attracted record-breaking funding, driven by global venture capitalists chasing high returns in emerging markets. But in the high-interest rate environment of 2024 and 2025, risk-averse investors are pulling back from volatile regions and demanding faster profitability. Many fintechs that relied on continuous fundraising to cover operating losses suddenly found themselves stranded. Layoffs, down rounds, and shutdowns have become common across the sector. Beyond financial pressures, another overlooked factor is trust. African consumers remain cautious of digital platforms, particularly after several high-profile scams, fraud cases, and system outages. In some cases, fintech firms failed to deliver on their promises, leading to user disillusionment. Even promising tools like cross-border payments face hurdles in regions where cash remains dominant. Please like and subscribe to keep this channel alive. That said, fintech in Africa is not dead, it is evolving. Rather than flashy disruptors, firms focusing on core infrastructure, regulatory partnerships, and profitability are gaining traction. Payments giant Flutterwave, for example, has adopted a more cautious strategy, securing regulatory licenses before expanding. The lesson is clear: sustainable fintech innovation in Africa requires patience, compliance, and an understanding of local market realities, not just fast growth or Silicon Valley-style bravado. In summary, fintech's initial boom was fueled by hype and venture capital, but it is now undergoing a painful correction. The survivors of this shakeout will likely be leaner, more transparent, and far more embedded in Africa's complex financial ecosystems.